All right, hey everybody, this is Scott here again with a very quick video. Today is Wednesday, May 4th, and in this video here, I wanted to just review the Fed's decision to increase interest rates by 0.5% today, which also, as you can see in the title of this article here, is the largest rate hike from the Fed since the year 2000. So this is definitely a very large move, and as I'm sure you can guess, this is to hopefully counteract inflation. So first, let's briefly go over this article. As you can see right here, like I mentioned, the Federal Reserve today on Wednesday raised short-term rates by 0.5% as part of an effort to tamp down the inflationary pressures weighing on Americans. Right, so as I've said on previous videos, inflation right now in the US is basically at 40-year highs. We have not seen prices across the board this elevated in about half a century. And so that's why, in theory, if you increase rates, if you increase the cost of borrowing money, that's supposed to have a dampening effect on inflation by basically trying to cool off the economy. And so then next, as you can see here in this paragraph, the central bank or the Fed suggested also that it will further raise borrowing costs or interest rates throughout this year as it attempts to undo its pandemic era easy money policies. Right, so essentially during the peak of the COVID pandemic, the Federal Reserve kept interest rates very low to therefore keep the cost of borrowing money very low and to generally encourage a lot of spending and provide stimulus to the overall economy. And of course, a major consequence of injecting a lot of stimulus into the economy is inflation. So now that we're pretty much out of the worst part of the COVID pandemic, now the Fed's trying to reverse a lot of their decisions and combat inflation by rising interest rates, making money harder to borrow, and trying to cool down the economy. And moreover, the Federal Reserve is also going to be detailing plans on unwinding its nearly $9 trillion balance sheet. So this was also part of the COVID stimulus process of buying a lot of assets, mostly purchasing bonds, injecting money into the economy, things like that. But now the overall balance sheet of the Federal Reserve has reached over $9 trillion. And so ultimately here, my general opinion on this is that I'm definitely glad to see the Fed unwinding a lot of its easy money policies because, of course, these super low rates and printing trillions and trillions of dollars is not sustainable. But at the same time, rising rates is going to probably cause a lot of problems now. Right, so for example, if we now come over to this article, which was written during the last federal rate hike back in March of this year, and as you can see with the title, it's pretty self-explanatory. Higher interest rates will raise interest costs on the national debt, and also corporate and personal debt as well. And so one of the important things to understand here is written in this paragraph right there. So basically, when the Federal Reserve changes interest rates, they're specifically targeting the federal funds rate, which is the interest rate at which commercial banks lend to each other overnight. And so naturally, if banks in general control the money supply in a country, as well as the borrowing costs and things like that, well, then if you change the cost for the banks to borrow money from each other, that's supposed to ideally trickle down into other kinds of interest rates and debt servicing. So basically changing the federal funds rate should affect your mortgage rates, should affect your credit card rates, your short-term treasuries, long-term treasuries, and all other kinds of rates as well. And so now because of that trickle-down effect, as you can see in this paragraph here, last year the Congressional Budget Office, or the CBO, projected that annual net interest costs for the government specifically would nearly triple over the course of 2022 through 2031. And specifically, the net change would be from $306 billion per year to now potentially $910 billion, and totaling over that period $5.4 trillion to service the national debt. And then moreover, continuing on here, it says inflation has been much higher than the CBO's projections initially, and the Fed is now having to raise rates earlier than the agency projected last year. So therefore, costs may rise even faster than anticipated. And for example, last year in 2021, the interest costs were around $20 billion higher than were projected. So basically, because inflation is rising so much more quickly than anticipated, the Federal Reserve is now being forced to raise rates much faster and by a much greater magnitude to combat that inflation. And therefore, our debt payments on a national level, on a government level, on a corporate level, and a personal level for mortgages, personal loans, student loans, things like that, are all going to increase substantially. And given that the country and many corporations are already choking on their debt, now having to deal with much higher debt costs or debt payments, this could cause, in my opinion, a lot of really significant issues in probably the near future. right? So the main thing that I'm worried about right now is starting to see people, companies, and countries starting to default on their debt because they simply can't afford to service that debt because of the higher cost. And oftentimes what a government at least might do to counteract their increasing debt payments is to simply raise taxes. If they can raise tax revenue, they'll have more money, ideally, in theory, to pay off their increasing debt costs. The issue with that, however, is when you do increase taxes, that puts a lot of downward pressure on spending on part of the consumer, right? If your taxes go up, chances are you're going to spend less money, which then also equals less tax revenue for the government. And then one more thing I want to show you in this video, if you come over to this third tab here and take a look at this chart, this is basically showing you the 10-year treasury rates in the United States, starting from the present in 2022 and going all the way back to before 1965. And so as you can see here, during the 1980s, interest rates actually got up to over 15%, which is actually pretty darn crazy, given that in current times, interest rates have been below 1%. And so I definitely don't think interest rates are going to increase all the way back up to 15+%. But the point here why I'm showing you this is just to give you a visual sense of how much potential room there is for interest rates to rise further. Right, as you can see right there, during the peak of the COVID pandemic, when, as I said, the Federal Reserve was trying to intentionally keep rates near zero, they got down to a low of about 0.55% for the 10-year treasuries, which when you think about it is pretty darn insane, right? Imagine loaning out your money for 10 years and only making 0.55% annually. That's a very small amount of money, a very small return for locking up that amount of capital for that time duration. And so then now, as you can see in recent times, interest rates are starting to rise again. Partially because of what the Fed is doing, and then also because of just the bond market, the interest rate market in general. And so as of now, the 10-year treasury rate has increased to about 2.3%, which is a substantial increase over 0.5%, right? That's almost a 5-fold increase. And perhaps rates can go to 3%, 4%, 5%, or even higher. So we could see maybe even a 10x increase in rates. And then when you translate that to your debt payments, I mean, imagine the payments you make on your mortgage going up by 2x, 3x, 5x, or even 10x. That would be a huge, huge increase on your mortgage or on your credit card payments, for example. And especially if you're the government or some badly run company, which always spends more than you even make, that's obviously going to be a huge, huge problem. Now your cost is going to be increasing and your revenue might be staying the same or perhaps going down as well. So ultimately here, guys, definitely don't want to try and scare anybody. I'm just a bit concerned about this current environment with huge amounts of debt, inflation, rising rates, and things like that. And this is why I'm definitely very bearish on the stock market in general right now. Right, so for example, even if we come over to Thinkorswim real quick and we take a look at SPY or the S&P 500, and we'll go ahead and zoom in a bit here on this chart. As you can see with today's candles, this is the market's reaction on that Federal Reserve's announcement. And right now, for some reason, the S&Ps are up by well over 2.5%, or almost 2.5%. And this, of course, makes no sense to me because these problems are not going away. And really, once the market began this decline back over here, basically at the beginning of 2022, this whole downturn began from the fears of rising interest rates and all the issues that would come from that. So even though along the way we've seen some pretty monstrous bear market rallies, especially with this one right here, I personally don't think we're going to be working our way back to all-time highs anytime soon. Right? I don't see all these issues going away in the near future, and they probably will get worse. So that's why I'm still very bearish on the market. And so ultimately just wanted to make this video to keep you guys informed as to what the Federal Reserve decided to do today and what the potential impacts of that might be. And not just for this rate hike, but many more that will come in the near future. So even though I don't expect to see anything crazy happening with large-scale debt default or things like that in the near future, but over time, over the course of this year and into next year, as rates do continue to gradually get larger and larger and larger, we might see some very, very significant issues starting to emerge. And so with that being said, that's going to do it for this video. And as always, if you've got questions or if you have any thoughts you want to share, please do so in the comment section below. Moreover, if you are interested in taking some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And if you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.